Welcome to The Explainer, where we break down the really complex forces that are moving the markets. Today, we're diving into a market that is just caught in this massive tug of war. You've got a geopolitical shockwave on one side, and on the other, a government spending tsunami. The old rules, they're gone, and we're here to figure out the new ones.
All right, let's just get right into it. A major conflict erupts in the Middle East. Now, for decades, the market has had this standard, almost knee-jerk reaction. It was a playbook that every single trader knew by heart. But this time feels really different.
So yeah, that old playbook, it's been completely tossed out the window. Traditionally, you'd see stocks sell off hard, and all that money would rush into the safety of government bonds and gold, right? Pushing their prices way up. But just look at today's reality. Stocks are wobbly, but they're not crashing. And this is the unbelievable part. Both bonds and gold, the classic safe havens, are falling. So what is going on here?
Okay, so here's the crucial point. That stable, just right, Goldilocks market environment that, investors just loved, it's officially over. What we're witnessing right now is a war between two colossal opposing forces for control of the entire economy. And it's creating a market that, frankly, none of us have ever seen before. So let's investigate our first suspect in this whole market mystery, a classic geopolitical spasm that's flooding the system with a very, very unwelcome guest. And its name is inflation. Now, what's really wild here is just the sheer speed of this shock. We're not talking about a slow burn. This was an explosion. Brent crude oil blasted past $85 a barrel, and European natural gas, it surged 80% in a matter of days. This is giving everyone some serious flashbacks to that 1970s-style stagflation, where prices just keep rising, but the economy goes nowhere.
And I love this analogy from Jamie Dimon. It just perfectly illustrates the problem. This isn't the kind of inflation that central bankers can just gently manage. No, this is a toxic, unwelcome guest that threatens to ruin the entire party. It basically forces the Federal Reserve to keep interest rates much higher for much longer.
But battling that inflationary shock is an even bigger and maybe even more powerful force. And that's a wave of government spending that's unlike anything we've ever seen outside of a world war.
The scale here is just staggering. I mean, we are talking about a projected $5.5 trillion in deficit spending over the next 10 years from a single piece of legislation. This is not just stimulus. This is a fiscal tsunami. It's designed to just power the economy through any kind of downturn. So what you have is the inflationary headwind from the war meeting this massive pro-growth tailwind from the government. It's a titanic collision.
So how is this epic battle actually playing out in the markets? Let's go look at the evidence, kind of like a crime scene investigation, starting with the bond market, because that's where the first rule of crisis investing has just been completely shattered.
Think about it. During a war, investors traditionally dump risky stocks and they rush to the safety of government bonds. That pushes bond prices up and interest rates or yields down. It's called the flight to quality. Well, that rule, it's dead. Totally defunct. And this slide just brilliantly illustrates why. Instead of falling, the 10-year Treasury yield surged past that key 4% level. So why? Because the market's fear of inflation, which is being fueled by those energy prices and all that government spending, is now actually greater than its fear of the war itself. Investors are demanding higher interest payments, not just for risk, but as compensation for this huge flood of new government debt and the threat that inflation is just going to eat away their returns over time. So if money isn't fleeing to bonds or to gold, where is it going? Well, right here, the US dollar index. You can see it's surged past this key level of 99. It's acting like a dollar vacuum cleaner. When there's this much uncertainty, investors are just hoarding US dollars. And that sucks liquidity out of the rest of the world, creating a whole other layer of financial stress.
All right, let's shift gears to the stock market, which, if you just glance at it, it looks surprisingly stable. But when you start to look under the hood, you realize it's all an illusion. It's a mirage. And this chart just illustrates that mirage perfectly. The regular S&P 500, which gives more weight to the biggest companies, it's holding up okay. But the equal-weighted version, where, Apple has the same influence as the 400 largest company, that is showing some serious weakness. This tells you the whole market is basically being propped up by just a handful of mega-cap stocks, while the average company is really, really struggling.
So the market support isn't coming from a healthy, broad-based economy. Nope. It's coming from what you call technical distortions, basically the plumbing of the market itself.
You've got extreme concentration in just a few giant tech stocks. You have traders who bet against the market getting squeezed and forced to buy back shares. And then you have this massive volatility being driven by options that expire in less than 24 hours. The problem is, these things can reverse in an instant.
And this might be the most crucial point. The true weakness? It's hidden. It's away from the public view. The real signal isn't what's happening on the New York Stock Exchange. It's what's brewing in private markets. We're seeing a record $3.8 billion in withdrawal requests from a single major private credit fund at Blackstone. That is a huge red flag that the stress from higher interest rates is starting to cause major cracks just below the surface.
You can see the story playing out in real time, right here in this table. The money is rotating. It is flowing out of those sectors that are really sensitive to interest rates like IT and all those high-flying software stocks. And it's flowing into what we call hard assets, companies in the energy and defense sectors that actually benefit from conflict and inflation. Meanwhile, higher gas prices act like a tax on all of us, on the consumer, and that hurts spending power.
But here is the ultimate tell. In a crisis this big, you would expect gold and maybe even Bitcoin to act as safe havens. The fact that they are both being sold off, right alongside stocks and bonds, that sends a really chilling signal. This is a desperate dash for cash. It points to a severe liquidity crunch under the surface. People aren't just reallocating their money, they are liquidating everything they can.
So, after looking at all the evidence, what's the final verdict in this market mystery? And more importantly, what does this all mean for your strategy going forward?
Well, the verdict is this. The old rules are obsolete. They're gone. Because we are locked in this epic macroeconomic tug-of-war. The inflationary shock is trying to pull the market down, while that government spending shock is trying to pull it right back up. And the result? Extreme volatility. It means that neither a full-blown crash nor a healthy, sustainable rally can win. At least, not yet. So the crucial takeaway here is that you need a brand new playbook to navigate this environment. The focus has to shift to defense. And that means a few things. It means reducing your exposure to long-term assets because those get crushed by rising rates. It means prioritizing real assets that hold their value during inflation. You want to hold a healthy amount of cash for safety and opportunity. And above all else, focus on high-quality companies with real profits.
And you really need to be prepared for two very different outcomes. Look, in a bullish world where the conflict de-escalates and oil prices fall, that could be a green light to buy some of those beaten-down growth stocks. But in the bearish scenario where the conflict gets worse and oil breaks $100, the strategy completely flips to aggressive defense. You sell your riskiest assets and you raise your cash position, maybe significantly. The price of oil, that is your key signpost.
But while everyone is staring at the war and watching oil prices, the biggest danger might just be the one we uncovered hiding in the shadows. And that is a systemic credit event, a domino effect of defaults and fund freezes in the private markets that suddenly spills over into the public markets. And this brings us to our final, most crucial takeaway. That old Wall Street saying, buy when the cannons are firing, it's a relic. Forget about it. That strategy only worked in an era when central banks could just flood the market with cheap money to fix any crisis. But today, with inflation as the skunk at the party, that option is completely off the table. The playbook has changed. Now is not the time to be a hero. It is the time to hide behind the shield of quality.